Welcome to Slackin Off with Brady Slack.
Welcome to another episode of Slackin Off. I'm your host, Brady Slack, and I always am impressed with the guests that I'm able to have on this show. Today is no exception because we're going to have a really good conversation. I have a feeling about this, Frank, about wealth management. Hanna comes to us as a private wealth manager, and without further ado, Frank, thanks for hopping on Slackin Off today.
Yeah, thanks, Brady. Really excited to talk to you. I know it's been a long time coming, and excited to have a conversation and, learn a few things from each other and hopefully create some value for the listeners.
We always do. I think that's the fun part about it is no matter at what stage you're in, whether you're just starting a business, whether you've been a business owner for 30 years, there's always opportunity to learn and grow and maybe pivot or change what you're doing in your business. One thing that I just kind of want to start foundationally. A lot of what I've been able to learn about you, Frank, is a little bit more of the entrepreneur aspect. And I think that is unique when it comes to financial advising because typically wealth managers are, maybe they start out in the insurance game and then they work their way up into more of a holistic financial advising. But you have a little bit more of an entrepreneurship background. Tell us just a little bit about that, if you will.
Yeah. So I grew up kind of in the restaurant business. My father, kind of grew up, started bussing tables when he was like 14 years old. And he just knew from an early age, that's what he wanted to do. So he built, I'd say a really successful restaurant portfolio in the hospitality space. At one point in time, he had 15 restaurants. And so at an early age, I worked up through the restaurants and was kind of thinking to myself, hey, this is what I should do. He definitely, guided me in that direction and really kind of, in a nice way, I'd say, pressured us into saying, hey, you guys need to carry the torch. I have two siblings and grew up thinking that's what I wanted to do. And I did that from probably age 12 to about 30 years old and learned a lot of great things. And I think it's led me to a successful career in financial planning. But at age 30, I just said, hey, you know what? I don't love this. I knew I wasn't going to be as successful as my father was. And I said, hey, you know what? I've learned a lot of useful tools, kind of on the streets here, build a lot of good relationships. And I think I could take that to another level. And I learned a lot of other stuff. We had, a lot of real estate holdings. We did a lot of estate tax trust planning. So I had a high level understanding of how that worked. But I left the business to the chagrin of my father and kind of started this financial planning, business that's evolved over time. We've been in business for about 14 years and have grown, to over $1.5 billion of assets under management. But I think what makes us kind of unique is I've been on the other side of the table as an entrepreneur and I know what goes into the decision making. And it's easy for a financial advisor or somebody to tell you, hey, this is what you should do. But there's a lot of emotional decisions. There's family decisions. There's a lot of things that go into that. And I think people appreciate that from our business model. And they say, hey, you guys have run businesses. You know what it's like. Yeah. And I think that's, kind of separated us from some of the more traditional insurance or wirehouse, advisors that, I would say are looking to sell.
I want to come back to that in just a minute because I think I want to have a conversation about this idea of the traditional financial advisor and maybe some of the limitations that they cause themselves because of the lack of experience that they have. But first, I want to dive a little bit more into this relationship with your dad. I think now coming from myself, my parents owned a couple different businesses as I was growing up, nothing major. A couple cleaning business. I know how to scrub a toilet really well. I don't like to do it, but I know how to scrub a toilet really well. But what are some of the good things that you learned that you took from what your dad taught you? But I also, if we're okay with it, if you're okay with it, what are some of the things that you learned, maybe what not to do as an entrepreneur that you learned from your dad?
Yeah. So he really, from a, wealth accumulation standpoint has been like super successful. He's one of the more recognizable guys in Maryland in that regard. So he gave us a lot of really good advice on attention to detail, diversification. You know, he's like a workhorse. So the work ethic side of things, you know, I always said, regardless of what field I was going to be in, there's nobody that's going to be able to outwork me. But he always, you know, prepares for a rainy day, I would say, for lack of a better term. He's always, you know, ultra cautious, ultra conservative. And I would say that served him well. There's no argument that he's done really well in that regard. But when I left the business, frankly, he told me I was the stupidest son of a gun and he was dead serious. And I left with, you know, next to nothing. We didn't talk for probably close to 6 months, and then got this kind of business up and moving. And ultimately, over time, you know, made him a client. But yeah, so I'd say there's a lot of positives there, but you got to be happy in what you're doing. I was not happy. No amount of money was going to make me happy. I used to joke in the first few years and say, if he called me and said, "Hey, I'll give you $10 million a year to come back and take over your old job," no way I would do it.
No, I think that's good. Did you have to learn how to maneuver the relationship between like a dad and maybe a mentor or a boss? How was that relationship like? What was that like?
Yeah, it was not good for a long time. We butted heads on a lot of things and, you know, saw things differently. You know, a lot of times he was right. Some of the times I was right. But I think, yeah, moving out of that business and getting into another business that he could kind of appreciate and see value in. Now I think we went from kind of like a father and immature son to peers in a way. So he's a big advocate for our business now. We do business with him, but a lot of people trust his judgment. So he's kind of been like a brand ambassador for us in a way. So it's been really satisfying to kind of get to that point where, you know, we probably hated each other for a few years there and repaired that, and life is good. So
as a son, I think one thing that at least me personally, I'm always trying to do is trying to make sure that you know, that father figure is proud. You know, even if it's never said, you know, they made them proud.
Yep.
Have you ever felt that? Have you feel like you've reached that point?
Yes. Yeah. We're not like, my family's not a, you know, emotional, I love you type family.
Yeah.
So it's, you know, it's one of those things that's mostly unspoken, but, you know, he has told me he's really proud of me, and I can tell too. So
good.
I left the business, moved from Maryland up to Pennsylvania where my wife's from, and kind of started a new life from scratch. And it's been amazing.
That's good. Good for you, Frank. Now I want to come back to the comment that you had mentioned earlier, as it relates to the financial advisor not having a ton of experience. One thing that I note being a tax advisor is that sometimes it's really difficult to have a good relationship with a wealth advisor because they don't understand the business aspect of things. Where do you see the problem there, or what bridges could be built to help shorten that gap, do you think?
Well, I think, you know, at the end of the day, I respect anybody that's in this business because it's definitely a punch you in the face business, and there's a lot more rejection than success, especially in the first early years. But I'd say like the industry has evolved a lot, right? So, you know, decades ago, you thought of stockbrokers, right? You had these stock pickers, you had the Merrill Lynch, Morgan Stanley's, the big kind of wirehouses, and everybody had relationships with them. And they're not bad groups, but over time, which you can kind of attest to, you know, cost matters, you know, results matter, performance, and, you know, most statistics show you that stock picking, you know, active trading, it's really difficult to outdo the market. And then you have, your more insurance based, general agency type, firms. And there's like quotas with those groups. So I think there's a serious like axe to grind when you're going out to a client and you've got the greatest product under the sun and that's a perfect fit for everybody. But at the end of the day, if you're not independent and if you're not objective, somebody that's successful in their own field is going to like smell you coming a mile away. So there's skepticism and there's a lot of dishonest people in our business and a lot of businesses, right? And they're looking out for number one, versus the best interest of the client. And I started out in a firm where we had to sell a certain amount of these certain types of products that we didn't love and they weren't in the best interest of the clients. And we suffered financially if we didn't meet those goals. And I ultimately left that group and I said, you know what, this isn't fair to me. It's not fair to my investors, my clients. So we have a completely independent and agnostic business model that I think, clients trust. I think everybody's had some experience with a financial advisor and almost everybody's had a bad one at some point in time. So I think there's a lot of skepticism there. But ultimately, I always say, hey, if you always put your client first, if you always have their best interest in mind, it's going to be really hard for you to screw up and, get fired per se. Not every decision we make is right and not every maneuver we make is going to work out. But I think that's what people appreciate.
I think, like I always say, people don't know how much you care until they know how much you care. You know, or they don't care how much you know until they know how much you care, kind of deal. And I think like that's the same mentality there. What, I guess maybe coming from the opposite perspective, tell me what I don't know. What, from a tax perspective, what could accountants do better in maintaining that relationship with a client's wealth advisor or asset manager?
Yeah, I think it's just rapport and trust, right? So I appreciate accountants. They have, a really demanding, labor intensive job. And I've got some really good relationships with accountants. And I think, at the end of the day, you put a lot of time and energy into building those relationships with your client, right? And for you to hand them off to somebody like me or somebody else that you may not, know well, you're putting a lot on the line if we screw something up, right? And same thing, with you. It takes time. If I'm going to refer a client that's interested in a new CPA or accounting relationship, I want to know that I can trust you and you've got a business model that you're not, overwhelmed or going to, struggle to, deliver for the client. So I think it all comes down to trust. It's trust, relationship, confidence, and being good at your job, right?
Yeah. From your perspective, when you're working with clients, what are some things that you like? I guess what are some aspects of tax management or tax planning that you're seeing that they're overlooking that could be implemented a little bit differently, or maybe even be improved with your clients?
So I think it's difficult owning a business, running a business. A lot of people, start it and it's a challenge to make it profitable, right? So I see a lot of people, not paying themselves first, right? So they stop, they don't take a salary. They try to say, hey, I'm going to just reinvest everything into the business. And they miss out on some of the tax benefits of, paying yourself, paying your staff, paying your family. My wife and kids work with me in the business. So I pay them a salary and then I utilize things like, 401k with profit sharing, cash balance pension plans. My kids have Roth IRAs where I pay them the maximum, or the minimum to be able to take advantage of the kiddie tax. And I kind of look at it as, hey, it's a right pocket, left pocket move for me. I stick it in a Roth IRA, let it grow tax deferred. And, if they treat me well down the road, I'll give it to them.
What?
But there's a lot of maneuvers like that where it's just simple stuff. But if you're not if you're not proactive and somebody's not bringing that idea to the table, you're going to miss it. Right. And a lot of accountants are good guys, but they have a lot of clients, right? So they're busy. And by the time they get all the information from the client to be able to put together a tax return, it's too late to take advantage of some of those maneuvers. So that's something where, again, we have ultra affluent clients where, they've accumulated wealth, right? And now it's about, how can I protect my family, take care of the people I want to take care of, versus the federal and state governments.
Yeah.
And so we'll do a lot of high level estate and tax trust maneuvers, gifting, that type of stuff. But we have a lot of clients that are probably, my age, your age, younger, that it's all about, it's not how much you make, but how much you keep, right? So what kind of maneuvers can we introduce that are going to make a sizable impact over 5, 10, 15, 20 years? You wouldn't believe the amount of people I come to that are in their 50s, 60s, and are saying, hey, I'm going to retire soon. I'd like to work, 5 more years or 3 more years. And we crunch the numbers and it's just not feasible. They either mismanaged more, or they didn't get the right information, or they didn't save enough. And it's sad to see at that point, because there's no magic trick that's going to create, the funds needed to kind of carry them through retirement. So,
let's dive into this kind of idea of this asset protection, wealth protection idea that you talked about with some of these affluent or ultra wealthy clients that you have. What are some of the things that those individuals are instituting? And I'll preface it by saying sometimes I'll hop into phone calls with clients who are on the vast opposite of the spectrum, where maybe they're just starting out, like you mentioned, younger, hungry, and they're like, hey, I need to set up an LLC for this thing that I'm doing. And it's like, let's just go get proof of concept, make $1, and then we'll talk about the entity. And then kind of further along down the road, it's like, I need to have a trust with this entity structure. And it's like, well, you have no beneficiaries and you really don't have any assets that we would need to put into that trust, right? So what are some of the things that, I guess, what maybe are some of those thresholds, or what are some of those things that people are doing from an asset or a wealth protection standpoint that people could benefit from?
Yeah. So, great question. So I would say on the younger side of things, if you've got a relatively, new business and it's profitable, the easy maneuvers are, incorporating the business. If you've got assets, LLCs, different things like that are simple maneuvers to give you, like, a few layers of asset protection. If, we've got new clients that have really unique or, sophisticated businesses where we think they've got like a high probability of appreciation on that asset, right? And they're making maybe hundreds of thousands or millions of dollars a year. And that asset now is relatively low in value. We might look at some type of, family limited partnership or some type of trust that is basically creditor and predator proof, but also gives them control, but also can kind of keep that future wealth off of their balance sheet, right? So when they get out to their 50s, 60s, and an attorney's telling them, hey, you need to do some estate planning. Well, now I've got a 10, 20, $30 million asset, and you can't just give it all away. And I'll walk through those laws, but it's a lot easier to do some proactive planning early on in life, early on in those years, than trying to, do that later on in life. And I had a client that I chased for years, and he just passed away, and his wife had passed away about a year ago. And it was one of those cases that I was so frustrated. I could never convince the guy to do any planning. He was an old school Italian guy, Italian family, and the kids were at odds while the parents were still alive. And he just passed away. And I think they valued the estate at like 150 million. Wow. And I don't know if you're probably aware of this, but so the federal estate tax exemption right now, I think, is roughly
like
about
12.85 or something.
yeah.
$13
So it's
million.
about 25 million if you're married, right?
Yep.
So everything above that is taxed at 40%.
Yep.
So, these kids are going to go to war over what's left, and nobody benefits in that situation other than, the people cleaning up the mess and the state and federal government. So that's just been one case that it's so frustrating that I never could get that guy to move, but nicest guy ever.
Yeah, I see this a lot. So I have quite a few different family members that are in farming, and I'm the biggest wannabe cowboy you'll probably ever meet. So the whole farming industry and asset protection as it relates to what the land is, I'm a hardcore Yellowstone fan, so I'll throw that out there. But it's really interesting to me because that's another place that I see estate planning not be utilized, and it's rough. We hear about families that have to sell off farmland all the time because things weren't protected correctly when the parents passed away. And so now just to be able to pay the tax bill, the kids have to sell the land, and then the family farm that's been in the family for generations is now gone. Right. And those similar situations happen all the time where you've got an older parent or a grandparent who owns a business and they haven't structured the estate correctly. And when they do pass away, that gift and estate tax exclusion eats up a lot of what's there, and whatever assets are left remaining typically just get sold to pay off a tax bill. And whatever you did have is now gone because you didn't plan effectively. And it is sad. I've had some situations that I've been in where all I can say is sorry, but this is what we told you to do, and this is why we told you to do it, and now it's gone. So I feel that.
Yeah, so we do a lot with farmers. Again, I'm primarily East Coast. I mean, we've got clients all over the country, but I'd say, our footprint's probably more East Coast, but there's a lot of, land development. I wouldn't say they're like the kind of the ranches that you see on Yellowstone, but a lot of valuable land that developers are coming in and they're buying that land out. So we're helping them with that type of planning. But yeah, if they hang on to the land and something happens, most of those farms, they're land rich, cash poor, and they can't come up with the money to pay the tax. They're forced to sell an asset at a fire sale price because everybody knows they're in trouble. And it's just not a good situation. So we see that all the time. And I joke that there's some farmers, and you can see I'm dressed pretty casual today, but I remember going to see a farmer and I was wearing a suit and tie. And I walked up and this guy looked at me and he was like, "Are you from the IRS?" And I was like, "No, I'm Frank. I scheduled a meeting with you." And he just in a nice way told me, "Don't ever wear that outfit around those parts." So I've the most dressed up I'll get for a meeting with a farmer is maybe a polo shirt and shorts nowadays. But
better pull out your boots and jeans, right?
Yeah, exactly.
No, it's funny. We're kind of on a real estate train here talking about land. I know you do a lot with real estate, but I guess maybe before we dive into the real estate, because I like to talk about real estate, it's a fun subject. Talk about just like holistically what you would do with a client. If someone is interested in working with Frank Hanna and RevX, what's kind of the holistic view? How are you working with this client, and what are some of the things you're talking about?
So we typically want to go through what we call like discovery with the client, really. So we want to kind of be able to like look under the hood, so to speak, and really understand what you have, how it's titled, what your goals and objectives are, and see, once all the worst case scenario items are taken care of, where if he or she is gone tomorrow, what that looks like, if there is disposable income. What do they like? What do they don't like? Typically if they don't have much money, we want to systematically, start an investment plan where we're just taking relatively small dollar amounts and, maybe dollar cost averaging them into the market in pretty liquid investments. Now, if they've already got those type of assets set up and maybe the retirement type accounts or more brokerage accounts, and they're interested in something a little bit different. We have, kind of a real estate arm, which, I guess we would call alternatives. And those type of assets have performed really well. Some people like the fact that, they can participate in, a tangible asset that they could go look at, touch versus, a mutual fund or an index fund or some type of, investment where they can't really understand what they own. But typically at the end of the day, we want them to be as balanced and diversified as possible. I say this. So my father and a lot of my clients made a ton of money on individual bonds from like the late, mid 90s to probably, I don't know, 10 years ago. Right. So interest rates were so high. They got high quality individual paying bonds, really nice coupons. Interest rates came plummeting down over time. Values of their bonds went up, and he made a fortune. And so I've had to slowly say, hey, listen, times have changed. You haven't been able to make that money in bonds. And, there's some interest rate risks with, what they've done, what the Fed's done in the last, year or so.
Yeah.
Meaning that you bought a bond a year or two ago thinking, hey, it's great. It's, it's high quality, but now you're underwater because they've raised rates. So, at the end of the day, we might've been leaning more alternatives, real estate over the last few years, and probably didn't do a whole lot with bonds. And the stock market is what it is. Statistics show it goes up over time. As long as you don't panic and you're not jumping in and out, you're going to make money in the long run. So we typically just try to, take advantage, look at the menu of options. If we're diversified across, real estate, equities, fixed income, commodities, whatever else we want to look at, at the end of the day, over a long period of time, you're going to make money. But you got to take the emotion out of it. I've got clients that, I don't necessarily manage a whole lot of money for that jumped out of the market in 08, 09 after getting slaughtered, and they've yet to get back in the market. They're still sitting on cash, and, there's nothing I can say to do to convince them to get back in, but, I'm sure they kind of kick themselves.
Are there clients that you have had to stop working with because they have too much emotion and that affects the ability for them to be successful in their investing strategies?
Yes, definitely. It's rare that we kind of fire a client per se.
Sure.
But at the end of the day, if you're devoting time, energy, and advice, and somebody's not taking it from you, it's frustrating. And I don't think that's a mutually beneficial relationship. There's some clients that we've done some high level planning, maybe some real estate, that type of stuff, and they've got their equity somewhere else. And I'm tickled pink about that because I can tell they're just gonna drive that other advisor crazy. But yeah, we've definitely had to sever a few relationships with people that just don't follow prudent advice, as we'd put it. And there's nothing wrong with it. I get it, but if I can't help you, there's no reason to pay me.
Yeah, no, that's good advice. One thing that you were talking about a little bit before that I think I don't want to overshadow it because I think it's important, has to do with the fact that, hey, you get to sleep with your business partner who happens to be your wife, and your kids are on payroll and things like that. A lot of the objectives that I try and reach with clients when we talk about tax planning are finding ways that I can still get a deduction, but not let that dollar leave what I refer to as my financial sphere. I can still touch it and I can still do things with it, but get the tax benefit for it. Mm-hmm. I don't know if it's if there's a piece of education missing. I don't know if there's a piece of just the actual execution of these items, but why don't you think more individuals take advantage of, putting a spouse or kids on payroll, taking advantage of a cash balance plan or a 401k with profit share? Now, in some instances, those are maybe a little bit farther down the line as far as planning tools that I would use from a tax perspective. But why don't more people take advantage of some of those things, do you think?
I think part of it is somebody hasn't brought that idea to the table. I have conversations, weekly, monthly with, people that are successful that have never done that. And they say, that's a great idea. I should have done that. I don't know why nobody brought that to my attention. So that's one side of it. And then I think some people get hung up on, having to allocate dollars that are kind of $59.50, right? Well, that seems like, light years away for a lot of people, even if they're in their 50s, when they know, hey, I'm parking those dollars there. You're telling me I can't touch them till I'm 59.5, or I'm going to pay tax and a penalty. So a lot of people get hung up on that. I see guys and girls that own businesses, and they look at their like rank and file staff, and they say, all right, well, Tom and Mary are really valuable, so I have no problem putting a little money away from them. But these other guys are knuckleheads, and I don't want to give them free money in the form of like, mandatory, safe harbor contributions in their 401k plan. So we go through that. So I see people get hung up on having to take care of their employees in that regard. It's funny. I see clients that I have that are so philanthropic and are actually like gifting their businesses to their employees versus their kids, which, makes sense for him and his situation. And I have a ton of respect for him. And then I have other guys that, want to keep everything in the family, so to speak, and pay attention to every little penny that goes there, and use and abuse their employees. But I think, to put a ribbon around your question, is I think it's lack of proactive, sound advice on different strategies that are out there. And then I think secondly is people get really hung up on, parking dollars somewhere that they may not be able to touch. And the easy approach is go buy another truck, go buy another, business asset that you can use and keep kicking that can down the road. When you and I both know, like, years,
there are better
decades.
options.
Yeah, there's other options, and they both work,
Yeah.
But yeah, time flies, and there's a lot of people that we come in contact with now that say, I wish I would have met you guys like 10 years ago.
Yeah. Hindsight's always 2020, but man, that 22 will kick you in the butt, right?
Yeah. Yep.
So one thing that I do want to ask you, because I'm curious, you talked about the maybe two different types of business owners, one who, hey, they're gifting equity to employees, they're very generous, and then the other one who, they're penny pinchers, don't give any more than what needs to. Do you see a direct correlation as to the success of the business based on one business owner or the other?
No, I would say the two examples in my head are both ultra successful, and they're both recognized. So they're both down in kind of my neck of the woods in Maryland. But yeah, so both highly successful. So I don't really see a issue with that. The one thing I would say is the guy that's really taking care of his employees has had his kind of leadership team in place for a long time, where the other guy, squeezes the orange or squeezes the employee until every bit of juice is gone, and that guy burns out or leaves, and they're constantly, kind of churning that position. Again, I see them both work, and I see why it makes sense on both sides of things. So I don't think there's a right or wrong answer. If it were me, it's probably a blend of the two.
Yeah.
You
highlight it, and I'm young, there's still lots that I have to learn, and people talk about things like that, and it's interesting for me to see it because it allows me to hopefully be a better leader, better employer, and create a better organization for people. So I was just interested to hear what you had to say about it.
And there's a lot of good tools to that. I mean, people like, benefits, 401k, profit sharing, that type of stuff that are going to put your employees in a better position for a retirement down the road. We do a lot with like deferred compensation, kind of golden handcuff type plans, where you can allocate some dollars and you can be discriminatory with who you put those plans in place for. So we've seen a lot of successful scenarios where you might say, hey, I'm doing the 401k and profit sharing for all my rank and file employees. We educate them. They appreciate it, but I've got 1 or 2 or 3 people that are so valuable. If they left and went to work for a competitor or, started their own business, it could cripple my business. So let me go above and beyond and put a plan in place where I can pick, a designated dollar amount each year. And as long as the business is profitable and they're doing what they should be doing, it can be a really, really, attractive deal to hang on to that really good employee. And I've seen people not do that and lose valuable people, and really the business really has suffered. And I've had other ones that really hung on to that individual long term, and the business really benefited from that.
Interesting. No, that's good insight. I kind of want to pivot, if you're okay with it, Frank, into
Sure.
the idea of this real estate conversation that we alluded to a little bit ago, mostly because again, this is just another difficulty that I see on a day-to-day basis when we work with clients and then we bring in a wealth advisor or an asset manager into the conversation, is a lot of the times those advisors they believe in the diversification, they implement elements of diversification, but they don't, I would argue they don't express that wholly, because a lot of what they're doing is not going to be investing into real estate, which is hard for me because I see the value in investing into real estate, both from a tax perspective and just a general asset or investment perspective. But one thing that I found interesting with you and RevX is that you do have a fairly open mindset when it comes to real estate and utilize real estate in some planning opportunities with your client. Can we dive into this topic? Tell me a little bit about what that looks like when you work with clients, what the conversation's like with real estate, and why you guys implement that a little bit more than maybe your traditional financial advisor.
Yeah. So I would say that, again, we're completely independent, agnostic. We look at it like, I'm going to give you the menu of options, Brady, and the advantages and disadvantages of each option, and then let you pick what you like. I've got a real estate background. I've done a lot of, traditional real estate investment, but if you really want to get into that, you need, a certain amount of money, right?
Yeah.
And that's not for everybody. You can be really successful doing that, but there's risk to that. So what we did with our company is said, hey, let's take some of our years of experience and success and kind of take sophisticated real estate deals, take advantage of the tax laws, and do, some type of syndication, or again, on the 1031 side of things, we've got deals where you can invest a relatively small amount of money and get access to some really attractive real estate in really attractive markets and hot asset classes, with as little as, a few $1,000s in some instances. So some people, look at that and say, hey, you know what? I know I want to invest in real estate. I don't know where to start. I don't have $100,000 to throw at something right now. How can I start? So we kind of recognize that and said, hey, how can we package, some of the things that these other big real estate companies are doing, kind of emulate that. But instead of, some of the thresholds with these big companies, they don't want to talk to you unless you've got $1 million, $2 million, $5 million, $10 million bucks.
Yeah.
A lot of our deals, I'd say our most attractive deals have minimums of, 25 grand. And there's other deals that you can get in for less than that, but a lot of people do that. And believe it or not, we invest in all our own deals too. And because I spend all my time guiding and consulting clients on my own, I've kind of been slower to invest in traditional real estate, because I know if I've got to manage that, it's going to take my eye off the ball, and that's going to cause my quality of life to suffer, and probably my clients as well. So what I do is every time I build up a little capital, I deploy it in one or more of our deals, and I get a nice monthly tax favored passive income.
Mailbox money.
Mailbox money. Yeah. Mailbox money. And I still invest in the stock market, and I still invest in my 401k cash balance plan. But I like that because it is a tangible asset that people kind of appreciate and like. I'll tell a story. Like I've got a farmer who sold a farm, and he was in a town, Bridgeville, Delaware, which is nowheresville, USA, and he loved Charleston, right? So he and his wife loved going to Charleston. So we had a multifamily deal there and a self-storage deal, and he did it. This was actually through a 1031 exchange, but you're able to use a concept called a Delaware Statutory Trust to do a tax deferred exchange, and you can redirect those funds into a prepackaged, professionally managed deal. So he reinvested in these two deals. He has no management responsibilities. They don't know who he is. He just parked his money there, but he goes down there every year, takes pictures, in front of the two buildings. He goes inside, talks to the girl at the front desk, and he calls me and he says, Frank, everything's going good. Place looks clean. Everybody's, and he calls it my self-storage and my multifamily apartment complex. And I said, that is yours. I mean, you might own the sidewalk and the fence out front, but he does own a piece of that. And I do that with my own. We went and looked at Auburn University with my son for college, and we have a student housing deal there. And I said, that's my student housing deal, guys. And that, it's funny how that works out, but I think people do appreciate that kind of tangible nature to a lot of our deals.
Well, I know I've been in some conversations, and this is just me personally. The reason why I have a hard time putting money into the stock market is because I can't touch it. It's not, I can see the product, if I invest in John Deere or Johnson & Johnson or Apple or whatever, I touch my iPhone, I touch my Mac every day, but I can't touch that tangibility, right? Which is why I'm personally, again, like I said, I like real estate. I'm more of a business investor. I like businesses and building things, and that's just me, me personally. Which I think is important to highlight. Like, again, from a wealth management standpoint, what are we doing for the clients that their biggest asset is the business, right? What do you look at there? How do you help that client?
So if their biggest asset is the business, again, we want to protect that, right? So, are they protected from a liability standpoint? Are they protected from a profitability standpoint? What are the risks in place? Is there a partnership? Do they have buy-sell agreements? Insurance tied to those buy-sell agreements? Is it is the owner the straw that stirs the drink? What happens? How do we protect that value for like a spouse and for kids if something were to happen to that? So we kind of look at all those kind of like worst case scenarios, and then we look at, what's the long-term plan with that business, right? Is he gonna gift it to the kids? Is he gonna sell it to the kids? Is he gonna bring in some type of, employee, stock option operator? Is he gonna look to sell? We've got relationships where we've facilitated large outside sale of businesses. After we get off this podcast, I've got a big call with a guy that is looking to sell 27 locations of a certain type of business. So we'll see where that goes. But, really try to understand what the plan of action is, what's the long-term goal, and then give them flexibility, right? Because things change over time. You start out with one goal, and then, your kid pisses you off, and now he's fallen out of favor, and you gotta look in a different direction. So what we try to do is just give them options, flexibility, and constantly revisit that to make sure that they're in a position where, they can't get caught with their pants down per se, and something happens. And now not only is there, some type of triggering event, but the value of that business that you spent 30, 40, 50 years building is gone for some reason or severely impacted.
We've kind of come full circle with this comment, but I think part of it has to do with create the plan, get something in writing, come up with an idea for what you want your exit strategy to look like, and then build upon that as you go. And I think the flexibility is important, but I think where a lot of people just fail is they don't start. You know, if you plan to fail, if you fail to plan, you plan to fail, right?
Yeah.
And most people they don't plan, you know?
There's never a perfect time. There's never a perfect plan, but you have to start somewhere, right? So whether it's
Yeah.
business planning, estate plan, nothing ever is going to be perfect. And you get that kind of analysis paralysis and you never do anything, right? And it's frustrating, but I always say another thing we're good at is we're good at tackling. So no matter how fast you move or how much of a pain you are to put a plan in place and execute, like we will be, a pain in your ass in a good way, politely persistent, whatever you call it, to get the ball across the goal line and actually get something in place, and then push you to, again, revisit that because it's going to change over time.
No, that's good. How can people get a hold of you? How can people work with you? I think that's a good segue into, I want to make sure that you pump yourself up. Tell people why they should work with you and how they can work with you. Besides having some of the social media outlets in our show notes, how can people work with you, Frank?
Yeah, so happy to talk to anybody, answer any questions, no strings attached. I don't care what amount of money you have, what your situation is. Happy to talk. You can email me at frankhanna, which is Frank HANNA at REV as in Victor, X as in X-ray, wealth.com. There's spots on our website where you can go in and fill out a little inquiry and it'll email us. Happy to talk to anybody. If you want to shoot me a text, call me on my cell phone. It's 410-430-2529, Maryland number. Happy to talk. Yeah, grew up in the restaurant business, so I work 24/7. You're not allowed to sleep in that business, so I regularly answer texts, phone calls, emails. My wife hates it, but I just it's in my blood to do that. So anybody has a situation, and we're constantly in situations where somebody's back is against the wall and timing is critical, and we have the scale and the manpower to kind of help out in that situation. So whether you're looking to just get started or you've got a business planning concern or issue, or you're selling a piece of real estate and you don't know where you want to go next, you're concerned about the taxes, you're interested in a 1031 exchange, call us. Happy to, again, answer questions for you. If we can't help you directly, we can guide you in the right direction.
Awesome. Frank, this was a great conversation. I think there's a lot of value that people can take from this conversation. And if you have any other questions, again, I'd highly recommend reaching out to Frank. I think it's a great resource to be able to have in your back pocket. So again, Frank, thanks for hopping on the podcast today. I appreciate it.
Yeah, thanks a lot, Brady. Nice talking to you.
Absolutely. For those listening, again, if you have questions, please, again, YouTube, like and subscribe. Send us a comment. Let us know what we can do to improve so we can always improve the show for you guys. But you have a good rest of your day. Slacking off. Thanks for coming on.
Thanks for tuning in to Slackin' Off with Brady Slack.